Welcome to S&P Capital IQ's monthly loan market update. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, the loan market was relatively flat in November as a result of rising loan supply as well as concerns surrounding the fiscal cliff. Before getting into our market analysis, we are pleased to announce the launch of HighYieldBond.com, a free website promoting the high-yield asset class. On it, you'll find recent market stats, news and analysis, relevant job postings, and an online primer that explains key high-yield terms. A link to the website can be found in this clip's YouTube info box below. In November, loan prices inched lower for the reasons mentioned before. Still, the S&P LSTA index managed to post a gain of 0.3% during the month on the back of interest accruals. Over the first 11 months of the year, loan returns were 8.8% compared to just 1.1% during the same period in 2011 when S&P's ratings downgrade of America's credit rating roiled the capital markets. Demand was not the issue in November. Inflows into the asset class continued apace. CLO issuance, in fact, rose to a post-2007 high of $8.3 billion. As well, retail investors poured $1.8 billion into loan mutual funds, the most since May of 2011. Strong demand was offset by swelling supply, however. In November, the amount of S&P LSTA index loans outstanding grew 1.2% to a 38-month high of $543 billion. With the loan market's technical equation a bit less issuer-friendly, clearing yields rose. The pain was not evenly distributed, however. For higher credit quality issuers rated BB or higher, new issue yields were effectively unchanged, while single B rated borrowers paid roughly 50 basis points more than they did in October. The flow of opportunistic paper also slowed in November. Though still a hot segment of the market, Dividend recap loan volume slipped to $6 billion from a recent high of $9 billion in October. Still, such activity during the first 11 months of 2012 totaled a record $56 billion. More dividend paper is expected to clear in December as issuers cast a weary eye on potential increases in dividend tax rates starting in 2013. Switching gears, the loan default rate pushed to an 18-month high of 1.2% in November as a result of Yell's default. The rate, however, remains about 2 percentage points inside the historical average. Looking ahead, participants expect inflows to remain bountiful in the first quarter, assuming, of course, no disruptive outside shocks intrude. CLO volume, for instance, is expected to finish out 2012 at $50 billion, about 2 times what got done during the 4 lean years of 2008 through 2011. Next year, strategists say volume will likely reach between $70 and $80 billion. Managers also see decent demand from retail investors that are searching for yield opportunities in today's yield challenge environment. For the same reason, allocations from pension funds and other institutional investors persist. The prospects for loan volume is less clear. With so much hinging on the outcome of the fiscal cliff situation, forecasting is even more difficult than usual. Lastly, we note a significant milestone for the leveraged finance market. In November, total high-yield bond and leveraged loan new issue volume climbed into record territory at $773 billion for the year to date. High-yield volume drove the bus here. In all, arrangers inked a record $317 billion of such volume between January and November. Leveraged loan activity, meanwhile, reached a 5-year high of $442 billion. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links to each is in the description of this video below. You can also download this presentation at slideshare.net.